There we go. We're live. How you doing, friends? This is the 0DTE morning market analysis for Friday, May 16th. And today I'm going to do a kind of a special segment where I'm going to dive a little bit deeper into our fat tail trades, macro analysis, and the type of trades that we might put on using our fat tail strategy or tail risk strategy. All right, but let's get to the macro report first and what's happening. This morning, oil markets are reeling from a 1-2 punch. It's a surprise OPEC production hike and renewed momentum towards a U.S.-Iran nuclear deal. So that means that crude has dipped to about 61 and change. And Brent is just a little bit above that, both posting modest weekly gains despite the bearish supply news. And the market is now pricing in the potential return of up to 400,000 barrels extra per day from Iran, adding to an already oversupplied outlook. And this development is injecting fresh volatility into the energy markets and could ripple across border equities, especially in sectors sensitive to energy prices. The reason why I'm telling you all of this is because that's all going to be impactful in our macro analysis and our fat tail trades analysis, the type of trades that you might put on looking for those tail risk events. So as we gear up for today's session, the spotlight is definitely on the energy sector. Overnight oil prices are facing downward pressure following those reports. And because of an increased production quotas, an indication that the U.S. and Iran are nearing a nuclear agreement. So that's a good thing. Such a deal could lift sanctions and reintroduce significant Iranian crude supply to global markets. Man, this Trump administration is like beating this. They are so busy. So while an immediate price reaction has been a modest decline, the implications for supply dynamics are substantial. So for us 0DTE traders, this scenario presents potential opportunities in energy ETFs like USO and XLE, of course, crude futures like the CL, as well as in broader market indices that are sensitive to energy price fluctuations. And we'll dive deeper into these in our analysis. So we're going to do both a 0DTE analysis for, let me just sort of, this is Optimus, by the way. Let me kind of break it down into the type of trades that we do that involve tail risk. If you didn't already know, our 0DTE trade, which is typically an out-of-the-money butterfly trade with the SPX, is also a tail risk trade. It's just the differences between this and our other fat tail trades is the time frame. 0DTE implying very heavily that it is on the very last day of expiration. It's a single day. It's a day trade. And so we're only looking within the spectrum of a day, certain types of moves, typically around 1 to 1.5 standard deviations. And if it does do a 1.5 standard deviation, that brings us right into our profit tent of our butterfly and produces tremendous returns. Of course, most of the time it doesn't do that. The market just doesn't move that big in one single day that often. So most of the trades that we do are smaller in nature, but we take super small risks. So even though they're smaller in nature, the return that we get on those basically outstrips any of the risk that we take or the cost of the trade. And so we basically go even. That means that we don't draw down. And that's the whole nature of the 0DTE thing, that most of the time we're playing for a tie. And you might think, well, what good is that? Well, what I had just said, we don't draw down. We don't lose. We don't lose money. We stay in the game, and then when those bigger trades come out, that extra standard deviations going beyond what is normal, or they're about 12 to 15% of the time, those are the things that move our needle. So that results in this beautiful equity curve where it's like sideways up, sideways up, sideways up, with very little volatility and hardly any drawdown. And you can make substantial money by not drawing down. I mean, I'm sure all of you recognize that drawdowns and unexpected losses are a huge thorn in your side. With us, the difference is that when you're experiencing an unexpected loss because of a big move that went against you, we're banking it, right? Not only in the short term, but also in the other fat tail trades, which are the extended time horizons. So we're also looking for 1.5 to 2 to 2.5 to 3 standard deviation trades, and in some of our strategies, as much as 3 to 5. Those are like huge moves. Those are like generational moves. But anyways, the 1.5 to 2 to 2.5, those are opportunities that happen maybe 20, 30 times a year. So in other words, a few times a month, and we want to be ready for those. But you have to be in the market. Of course, it would be expensive if you're putting on big risk, waiting for a couple of trades a month, right? So we don't. What we do is we put on trades that are super, super cheap. In the near term, we put on butterflies that are 1.5 to 2 standard deviations out that might only cost us 50 cents for the debit, maybe 25 cents. And for the slightly longer term ones, we put them on for 15 to 20 cents, maybe 25 cents for an out of the money put or call, depending on the nature of the market and which way it's going. And so that when those big moves come, we bank it big time. I mean, all of those trades that you got thrown out of because the market went the other way or went too far or whatever and just totally missed your trade, like you could have a credit spread on, right? And okay, yeah, so you banked maybe 50% return, but the market kept on going up, but you capped your returns because you're on that credit spread. We don't. We are taking full advantage of that move either direction and making huge money. All right, so that's the difference between what a retailer does and what a pro trader does. When those big moves come, we're already positioned to take those trades big time. So if you'd like to learn how to trade this way, where you can capture all moves, whether they're short, medium, long term, small, big, whatever, and never draw down. Well, let me qualify. Never draw down means that we draw down to a predefined amount where it is so easy to come back to a new all-time high in our accounts. So drawdowns are, my max drawdown in any single trading year is about 6%. Typically, I'm in the 2% range of my total trading capital. And in the meantime, when I'm not drawing down, I am making money. So that's really the difference. If you'd like to learn how to trade this way, the links down below will tell you all about it. We have 2 Skool academies, one that shows the very short term, focused on 0 DTE type day trading with the out-of-money butterfly. And then the other one is the fat tail trade that will show you campaigns that cover the wide spectrum of potential moves, market moves, and the time frames that you would be going or applying those campaigns. So that's called Fat Tail. So the first one is the 0 DTE Academy, and the other one is called Fat Tail AI. And there's a good reason why there's an AI there, because there's a huge artificial intelligence component in there where we'll teach you how to become operators in AI interaction. All right, now on to the reports. Let's see. Am I going to go to the right one today? Is it? Pretty close. All right. So we're looking for our 0 DTE trades, which are a tail risk or a fat tail strategy, which you probably didn't know, just in a short time frame, a single day, looking for about a 1.25 standard deviation move. We look at 3 things. We look at the volatility, we're looking at market direction, and we look at market structure. We look at volatility because that tells us how wide or narrow to make our butterflies. Volatility has been dropping steadily, as you can tell from our past tariff debacle. It's not really a debacle. From our point of view, we made money going up and going down because of that big move where all of you are getting priced out of the market. We are banking it big time with our fat tail trades. And then as it's coming down, we're making money all the way down. So not only did we make money on the way up, but we get that extra cash and we're applying it more and then doubling down or tripling down or quadrupling down. All right. But volatility is dropping. So from our butterfly point of view, we have to start going narrower. And that's what our playbook is over here on the left-hand side, showing as volatility drops, we go narrower and narrower. And we're almost into zombie land and exiting the Goldilocks zone. That means that we go even narrower. So now we're looking at maybe 20 to 30 wide, right? So we're right down here in the middle between these. And where we decide what side of that range that we're on is by looking at our at-the-money butterfly, our big-ass fly, to see where we are. So let's take a look at that now. All right. And you can see that as volatility drops, the debit on the big-ass fly, that 50 wide at-the-money E-mini S&P futures fly, that debit is increasing as volatility is coming down. So today it is at 22.65. Yesterday it was at like 19 or 20. Day before that it was around 18. Day before that around 17. And say a few weeks ago it was as low as 3.5 to 4 when we were in the midst of that huge downturn due to the tariffs. And so that debit is a reflection of the rate of decay of premium. So that's what's actually happening. As volatility goes down, the rate of decay of premium increases dramatically. And when that happens, all of the premium that's in options gets sucked out, and it actually gets its decay occurs earlier than that last day, so it gets spread out. When volatility goes up, that decay rate gets all backed up, and then that inflates premium in options so that it's sort of backloaded on that last day. And so when that happens, we have a very small debit on the 0 DTE day. So high premium means small risk or small debit and lots of potential in the butterfly. And low volatility means big debit, big risk, and less potential because of that rate of decay. So the real-time profit curve is actually like an indicator of that rate of decay. Right now, that rate of decay is increasing because the debit is big. Right. The other thing that happens is you get higher gamma in lower volatility times. So that's what's happening. So let's go back to our VIX. And so now we're starting to come up in this range, and soon we're going to be up here, right? So now we're at 22. Once we get to 25, we no longer look at the big-ass fly as a viable trade in the morning. So anything under 20, because the risk to reward is just too great. So there we are. We're still looking at 20 to 30 wide, probably looking at 20 wide to 25 wide, where yesterday we were looking at more like 25 wide to 30 wide. And that right sizes us for this level of premium that's available to collect. Next thing is to look at the market direction, and that's a no-brainer. We are definitely in a bullish bias. So in other words, on the 0 DTE butterfly, out of the money butterflies, we're going for call flies. But when do we get into the trade? Well, that's the next step. We look at our market structure. We're looking for pullbacks into these structural levels. These structural levels are determined by our analysis of volume profile. All right. Bam, bam. That's what we're looking for. So like yesterday, we didn't have, it just, screamed up. It did pull back right about here. So a lot of people found it difficult to to find a structural level to get into, because it just went screaming up through it yesterday. And then finally, when we did get up here, there was just a small move. Same thing happened on the day before. However, if you were properly positioned with our fat tail trades, you would have banked that. I mean, that would have been a huge move for you. All right. So that's what we're looking for. Pullbacks to these different levels. This is the top. This is one of the volume nodes that we're looking to perhaps bounce off of, and then structural levels here and here. So all of those are in play, and this is all based on the structural analysis that we do on the big picture volume profile. You can see we've jumped out of the fork node, out of the freedom node, out of the top knot node, and now we're coming up to the stair steppers. Bang, a bang, a bang, and then finally a breakout for all-time highs. That's where I see us going. Now, we might, as we get into these kind of steps here, these node steps, I think there's going to be a lot of opportunity for us to just sort of hang out here a little bit and kind of gain some momentum, gain some liquidity, and then jump out of here. That's going to be a natural thing when you come to a big high, like you can see here. It came up to an all-time high, and it's just sort of posturing itself and gaining for a breakout. Now, the breakout never came because the tariffs were hit, and then it just caused us to go into apoplectic shock. But here, there are no more tariffs. It's all good news coming out. And so I expect that we're going to come up here, maybe pause for a little bit, and then break out higher to new all-time highs. That's what I see happening, unless something else happens in the market that just totally throws a monkey wrench into the whole game. That's where we're going. All right. So let's take a look at crude. Where is here we are, crude. So crude has been steadily declining all this year. Here, we'll just choose a year. Steadily declining, and I think what we're going to see over the next coming days, because of this increase in oil, it's been announced. It actually hasn't happened yet, but as it starts happening and we see the impact, you're going to see crude move way down. So that presents an opportunity for our fat tail trades for significant moves to the downside. So we'll be taking both shorter term butterflies that are maybe 2 to 5 days out, and longer term long puts for an existential risk move that could happen. So we're going to be very well positioned. We have been, mostly because we've been getting these kind of reports all along. So we've already, put ourselves in position for those type of trades. But again, it's going to happen again. Very, very likely. All right. So, I don't know. Let's see. What else can I show you? Maybe some of our fat tail reports. Let's see if I can bring that up. So, when you join the fat tail community on Skool, you'll learn how to do the stuff that I'm about to show you. And let's see, there it is. So this is one of our reports, but I think the one that I really wanted to show you was first the opportunity analysis. And that's this guy right here. Is that what I'm showing? I think so. Yes. So this is our opportunity analysis. And this is all generated with AI. So when you go to the Skool.com/fattail, you'll presented with not only the fat tail strategy, but also an AI modules and technique and a whole course on becoming an operator, a master at interacting with AI. But anyways, this has all been created by AI for today. And our macro backdrop, it tells us, is OPEC. So these are the top macro events that we're trading for, and the short-term fat tail setups, Crude, XLE, SPX out of the, it's all telling us exactly what to do. Right? And this next report is similar to that, but it's aligning with the actual strategies that we take. And that's what this guy here is, aligning with our two short-term fat tail strategies is convexity stack and sigma drift. And it will tell us, which one of those it applies to. So we have different campaigns that we put on, and they have different scopes. And so when we get these macro reports, it says, hey, these are the trades that are more appropriate for this campaign or that campaign. And so then we look at that and we say, okay, cool. Now we know what to apply our trade to. And basically, it's kind of like a deeper analysis of the previous report. All right, let's go back to the big head. So there you go. First of all, these fat tail trades are kind of set and forget. You put them on, you don't worry about them. The risk is so tiny that you don't have to worry about it. But if they pull in, like I said, 20, 30 times a year for most of these reports, some of them a little bit more frequent, they pay huge. That means that you're never going to miss out on those big moves again. You always wonder, hey, how do all these guys get into a trade and know how to hang with that big move and make the big bucks? Well, I'm showing you. That's what I'm showing you here. All right. So join the Fat Tail, the Skool, skool.com/fat tail, and you'll learn how to do it too. How to make the big bucks when those big events happen. How to be in the trade before they ever happen. All right. There you go. All right. That's about it for me today. Weekend's coming. I hope you all have a great weekend. Coach Ernie, out.